Deep in the night, thousands of heavy-duty tow trucks are quietly slipping through American neighborhoods. They are pulling up to driveways, hooking up vehicles under flickering streetlights, and vanishing before the owners even wake up. These vehicles aren't going to the local impound. They are being hauled away to massive, hidden megalots across the country, lots that are currently overflowing with repossessed sedans, trucks, and SUVs. The repossession industry is completely overwhelmed. Agencies are operating 24/7, running double shifts just to keep up with the sheer volume of recovery orders flooding their systems. This is the physical reality of the $1.6 trillion auto loan market. The numbers on the balance sheets have reached a breaking point, and now the assets are being clawed back in record numbers. This sudden acceleration in defaults marks the first visible cracking of the financial structure supporting the American consumer. To see why this is happening, we have to look at how these cars were sold in the first place. To understand the origin of these recovery orders, we have to rewind and step off the repo lot. Over the last few years, dealerships across the country recognized a specific opportunity and aggressively targeted buyers who had nowhere else to go. Dealers began inflating the prices of average, everyday vehicles. They took decade-old sedans and slapped massive markups on the windshields, knowing buyers focused on the monthly payment. Traditional lenders usually reject loans that far exceed a car's actual value. To get around this, dealerships pushed buyers into subprime auto loans, contracts designed to approve almost anyone, regardless of their ability to pay the full balance. This chart compares historical car payments against new subprime contracts. People suddenly agreed to staggering $1,000 monthly payments for standard commuter cars. High interest rates were baked into 84-month terms, ensuring the debt grew faster than owners could pay it down. These loans were mathematically designed with zero margin for error. They required a perfect economic environment to survive, making a systemic failure inevitable the moment the economy tightened. That tightening arrived with historic inflation. The cost of food, gas, and rent spiked simultaneously, stripping the American middle class of their remaining disposable income. Consumers faced an impossible choice: buy basic groceries for their family or make the exorbitant payment required to keep their car in the driveway. The data shows exactly how they chose. This graph highlights the explosive spike in auto defaults, directly correlating with rising inflation. Every point on this line is a tow truck hitting a driveway, and a family losing their primary transportation. When the truck pulls away and the car disappears, the question becomes, who is actually taking the financial loss? The dealerships aren't the ones losing money. They were paid in full by the lender the day the car left the lot. The real exposure lies much higher up the financial food chain. To find the ultimate buyers of this debt, we have to look at the massive institutional Wall Street banks that funded the entire system. These banks bought up thousands of individual car loans and tightly compressed them into complex investment securities sold to investors looking for steady yields. This is the exact subprime bundling strategy used to trigger the housing collapse in 2008. The only difference is the asset being packaged. These toxic auto assets are now woven throughout the broader financial system, held in mutual funds and pension plans that represent the savings of millions of Americans. When the defaults reach critical mass, it won't just be the car buyers taking the hit. The entire financial system is positioned to take the blow when these complex investment securities completely lose their value. The American dream on four wheels has been weaponized into an inescapable financial nightmare. Subscribe to Bunker Finance to stay ahead of the crash and hear the truth.